my name's Roy Thompson. I head up Carpenter Box Financial Advisors. With me today is Henry Wilson. Henry is an investment manager at LGT. LGT being one of the investment managers we use and recommend for our clients. The sessions that we do, if you've listened before, are supposedly or supposed to be short snapshots around what's happening economically and with investment markets. So in kind of 5 to 10 minutes. Just to give you a bit of a snapshot. So Henry, welcome to our first one of 2023. Of course, what we've seen in investment markets is a much better start than we had in 2022. So investment markets have been particularly positive since around Christmas time, which, whilst is a very short period of time, is much welcome relief to sort of the I guess the way the markets were moving throughout the first part of last year. Any key reasons as to why this has happened in your view?
Yeah, absolutely. It's kind of relating to about 4 different factors, I'd say. But broadly, if we think about 2022 as a whole, there are a lot of risks that were there. When you invest, you have known unknowns, i.e. things that we know exist there and we don't know what will happen with them. And we also have unknown unknowns, so i.e. things that could just come out of the blue and you hadn't forecasted that they would, emerge. Last year, there were a couple of things that were really on investors' minds. The war in Ukraine, that could have escalated into a nuclear war. Inflation, that could have just kept on going up and up and up, could have got worse and worse. And therefore, interest rates in the US, for example, everyone was quite uncertain as to where they might settle. Would it settle at 4, 5, 6, 7? Who knows? It could have kept on going up and up and up. The energy crisis in Europe, there was a lot of talk about a cold winter being terrible for Europe and how it would mean that we'd have to do energy rationing and things like that. And then you had the kind of geopolitical side of things, China and the US and what China might do about posturing in Taiwan, but also the semiconductor kind of squabble that you've had between China and the US. So lots of things that were there in the back of people's minds and lots of risks that could have escalated and turned into quite damaging things for the portfolio. But as we crossed through 2022, all of those risks became much more kind of under control, knowable, understandable. And if you take kind of the nuclear war threat that we saw in Russia and Ukraine, it's still there, it must be said. I'm not saying that that's over, but certainly a lot of that saber rattling that we saw and things like that have got better. The inflationary picture's got a lot better. We've had 6 data points in a row that have shown that inflation's moved in the right direction. So just generally, a lot of those risks have dissipated. Other things, clearly, China ending their COVID lockdown policy is massive. Getting rid of the zero tolerance approach towards COVID is really, really good because the world is expected to go into a bit of a general slowdown in 2023. Having an economy with 1.2 billion people, who've got lots of cash built up after the 3 years of rolling lockdowns is really, really good, particularly for the European economy where we sell a lot of items and produce to China. So China coming out there, spending lots, buying fast cars from Germany, expensive wines from France and nice handbags from Italy is a boon for the whole of Europe as a whole. So those are kind of the main factors. Inflation also getting under control is clearly a really big one. And then, as I mentioned, also the energy crisis in Europe has not been nearly as bad as people expected. And if you take natural gas, we have Europe and the UK has strategic supplies of natural gas that for this time of year are very, very full relative to the last couple of decades of history. That's partly to do with governments buying a shed load of whatever they could get their hands on. We've been aided by the US sending a load of natural gas over to us as well. But it's also been because we've had one of the mildest winters on record. I know that seems quite contradictory saying that right now as I shiver in the office. Yeah. But I'm reliably informed that it is one of the mildest winters. And that's why we've not had to use quite as much energy as we anticipated. Commodity prices have fallen. Government debt has gone up, but it's not been as bad as people expected. And we haven't had blackouts.
I guess it's quite true as well that, people have been more conservative with their use, haven't they? So,
Definitely.
the fear position has meant that people, I certainly know myself, my wife's very keen to make sure the gas is off, the central heating's off, or the lights are off, or whatever it might be. So you magnify that over the whole of the country. It makes quite a difference. So
Exactly.
I'm quite interested in your comment around inflation. I think if you read the news, inflation still dominates. What we're starting to get is this kind of rhetoric around a recession. All of these things are bad news for investments, yet the markets have moved up. So I guess what we might say is that the markets, what's starting to happen is the markets are reading it that inflation it has peaked. Which is something we've spoken about in previous sessions like this, and that will start to fall away. So the market's going up because it's forward pricing that position. It feels that is now going to happen. What sort of confidence do you think the market has in that position? Is there enough data points that would suggest that is going to be the way it goes through 2023? And have you got anything anecdotally that would, perhaps support those comments?
Yes. Look, it definitely does look like inflation has peaked, particularly if you take the US, which is the biggest market and the one that kind of a lot of people use as the reference benchmark for valuations and just generally global investing. That definitely looks like it's peaked in the US. We've had 6 data points in a row, all moving in the right direction. And in the last 6 months in particular, we've had a couple of months where it's surprised to the downside rather than surprising to the upside, which is great news because in 2022, particularly in the early part of 22, it was majority surprising to the upside, which was a real issue. So definitely moving in the right direction. We do need to just be mindful, though, that we might have the odd surprise data point that might surprise people in terms of it coming in a bit hot, inflation coming in a bit higher than people expected for whatever reason. We'll be looking at not just historical inflation, but also future forward-looking inflation. So what does the future look like in terms of inflation? But also the Federal Reserve in the US will be looking at things like the labor market. The labor market is extremely tight right now. So the unemployment rate is at 3.5%. Yeah. And the Congressional Budget Office believe that 4.4% is around the natural level. So you can see that it's very tight relative to that natural level. And the tightness is causing wage inflation. So we have actually seen wage inflation lower in the last few weeks, which is good. We've also seen the participation rate, i.e. the number of people who are putting their hat in the ring to get a job, that's increased. A lot of people had retired or taken temporary retirement post-COVID. They're now coming back to the market. That's now back up at 61, 62%, which is also good. So things are moving steadily in the right direction. We've seen that.
You mean those people who might have benefited from, they'd amassed some savings. COVID sort of brought about this notion that they were going to be a retired individual, and what they might have seen is their investments go down, and the house go down in value, and they're feeling less comfortable, so they're returning to the workforce.
Exactly that, and probably a little bit of people also maybe they're a bit more comfortable things like COVID, and so they're now comfortable to go back and work in an office for whatever reason, but mainly for the reason that you mentioned. And so them coming back to the market will help alleviate the issues around wage inflation. So things are definitely moving in the right direction. And also, when we look at things like secondhand cars were one of the poster childs of this inflationary dynamic that we saw. They're coming down quite quickly now in terms of prices. Commodities have fallen quite quickly. Yeah. And we're starting to see, property prices have slowed down, particularly not just in the UK, but kind of globally, we're seeing it in various parts. So definitely moving in the right direction. One thing I would say is that ordinarily there's around a 9 to 18 month lag between when interest rates are first raised and when the economy starts to really feel it. So there are some sectors that feel it quicker than others, i.e. the construction sector, the property sector, obviously, that are very reliant on taking loans to finance projects. But other sectors, such as the services sector, typically that takes a bit longer for one to feel that in the data. And we've just started to see some impact of the higher interest rates on some of those less interest rate sensitive sectors like the services sector, which would indicate that growth is now slowing a bit, inflation is slowing, and that things are definitely moving in the right direction. But it's still a bit too early to say, inflation's all done, because while it's peaked and come down, it might settle at 3 or 4% rather than 2% like it was historically.
Yeah. So I guess something in there, we have lived in recent months, we've lived in a period where investment markets, I'm thinking of the stock market, if there was an announcement that interest rates were going to go up and that inflation was, in an effort to control inflation, at various points, that's been positive for the market because they've seen bad news almost as good news. What seems to be happening just in the last few weeks is we're returning to a more traditional position. Is it because the market has sort of got to the point where it's getting comfortable with inflation, so it's now starting to look at how deep a recession might be? Is that a reasonable
I think that's a really good point. That while everyone was worried about inflation, because inflation in the short term at least eats into the profitability of companies, and it also makes bonds look less attractive relatively. Because, for example, why would you take a fixed return on a bond giving you 5% when inflation is 10%? It's that kind of setup that meant that people weren't particularly interested in bonds and equities. And so as the economy slowed and as inflation came down, the market liked it because it thought that interest rates wouldn't go up higher and higher and higher. Literally in the last couple of weeks, we've started to see that bad economic news, bad economic data is actually putting the equity market down, which is a more conventional way of thinking about things. And that's definitely beneficial, I think, to move back to a more conventional approach in terms of valuing things and the way that markets behave. That's an interesting one to look at. And I think that, as you mentioned, people are now getting a little bit concerned about the prospect of some companies at least suffering against the backdrop of higher inflation, higher interest rates that we've seen for the last couple of years, and whether that will eat into their profit margins and their earnings. And this earnings season that we're about to enter will be really interesting to learn and probably give us a good insight as to what Q2 would also show.
So I was going to say, because we've started to see obviously some earnings being announced specifically in the US, and there's been mixed results. So some have been really positive and some less positive. Is it the case that the more positive ones, they're in a position where they've got greater resilience, that perhaps haven't got so much leverage in there? They might have better sort of repeat revenue streams, more cash on the balance sheet, that sort of thing. Are we seeing that correlation between those? Those sort of companies and the earnings that they make?
It's always about kind of how unique is your product, what ability do you have to pass on higher input costs to your end customer, how resilient is the management team, how adaptive, how much cash do you have on the balance sheet, are you heavily indebted? Those are the kinds of things that are really important. And the heavily indebted companies or with bloated workforces are the ones that are suffering at the moment. Because the cost of debt has risen, and labour costs have risen as well. So we've seen certainly some signs of weakness in the tech sector, and perhaps some of the earnings Microsoft had actually okay earnings today and yesterday. But the reality is that they have just laid off 10,000 people. So they're obviously reacting to what's coming down the pipe, which is that they expect to have slower and lower earnings growth.
Microsoft is an interesting one, though, isn't it? Because 10,000 people is an awful lot of people. But I've read reports that over the course of the last 3 or 4 years, they've been adding 12, 15,000 jobs per year. So another way of looking at it is saying that they've just repealed 1 year's worth of employment. So the 10,000 sounds dramatic, but actually, if you look at it over a period of time, they've still grown from where they were 2 or 3 years ago, and they're not laying off 30, 40, 50,000 people, which would be a repeal of 3 or 4 years.
That's a really good point. I think kind of most of those companies that the Google, Microsoft, etc., they're laying off around 3 or 4% of the workforce. So it's not kind of huge, but it's a meaningful number of people. But as you said, those companies were also in many ways the poster childs, the real beneficiaries of the working from home environment of COVID, where suddenly people needed more Teams, i.e. Microsoft Teams. They needed more Microsoft Excel, all of that kind of computer equipment. They needed more of it. So naturally, Microsoft hired a shed load more people to allow for continued expansion. And now people are going back to the office a bit more. They don't need quite as many people in employment. And so they're almost going back to, you've already mentioned it, it's just normalizing back to the kind of pre-2020, pre-COVID level, which also makes sense.
So what becomes important through 2023 is this notion of a soft landing, as it sort of been referred to in the press, and how likely we are to achieve that. And of course, central banks are achieving by putting up interest rates, they're combating inflation. That's what their central argument, of course. What they don't want to do is drive it to such a point that there's a huge deep recession. So the market is now sort of accepting of the inflation position and is starting to judge that position, how deep is the recession going to be. And what you're saying is there's a number of factors. If you suddenly saw a big layoff of lots of people across the labour force, unemployment rose quite significantly or higher than anticipated, that might be seen quite badly. Whereas if earnings retain or hold up, what you might say is that's encouragement that the recession's not going to be as bad as people might have thought maybe 6 months ago or something of that nature.
Definitely. If you take a lot of people in October time were very, very bearish, negative about Europe and the prospects for a recession there, in the build up to kind of the winter period. But actually things have been a bit more robust than people expected. And China coming on tap only makes that better. And the US have shown some signs of being able to bring down economic growth slowly, and inflation slowly, to the point that people are now expecting that they might be able to navigate this idea of a soft landing, which is when you bring economic growth from a period of elevated growth to a period of lower growth, but avoid the deep recession. The big question is it doable? I don't think it's ever been done where they've raised rates to such an aggressive level, or albeit from an admittedly very low level. But it's never been done that they've been able to raise rates quite so aggressively and avoid a recession. So that's the big kind of question. But China coming to the party is clearly a really big helper in terms of 1.2 billion people that want to spend money and things like that. And that's partly why the market's done so well this year, is people are getting quite a little bit optimistic about these green shoots appearing in Europe and the US and the prospect of the soft landing. But one thing I would say is it'd been one of the most forecasted recessions ever. Everywhere you looked, people were talking about 2023 being a recession. But the more that people talk about it, the more that it's in the price. And in many ways, the risk is more now to the upside, i.e. if we surprise to the upside, is because a lot of people have sold their holdings, will they suddenly have to get back into the market, which might cause the market to rocket up as people correct their underweight positions that they put in place at the end of 22.
And time will tell on that front, because bet your bottom dollar there will be a mixture of financial and economic information that means that the market will be volatile through 2023, I would have imagined. So but I guess what we might see, if we do see continued success in that inflation, it does become more normalized, and that makes it easier to predict moving forward, but it gives you a bit more stability in the way the market might move moving forward, which is a good thing.
Definitely. For example, last year bonds and equities fell in tandem, and it was one of the worst years for bond and equity portfolios for over 50 years. As inflation comes down, we expect that situation will kind of correct itself, and they'll adopt a more kind of conventional approach where bonds and equities might move in opposite directions, or at least not be 100% positively correlated, which is good. And bonds are also showing some value again. So, that's quite exciting. Yeah,
that's good. All right, Henry, that's conscious of time. I really appreciate you joining us today, and for your comments that you've made. As per normal, should anyone listening to this have any specific questions, more than happy for you to direct them back to me via the email that the link has been sent out on. But for now, thanks very much, Henry, and best wishes to you all.
Thanks, Roy. Cheers. Bye.
Thanks, Henry.